Global financial markets are shaped by a complex interaction of economic forces, political decisions, and investor sentiment. For modern investors, understanding these drivers is essential. Markets no longer react only to company earnings or local events. They move in response to global developments that influence capital flows across multiple asset classes. In recent years, investors have become increasingly aware that macroeconomic forces often define the broader direction of financial markets. Interest rate policies, inflation expectations, commodity prices, and geopolitical developments all influence how capital moves around the world. Recognizing these patterns helps investors interpret market movements more clearly and make more informed decisions. One of the most influential drivers of global markets is monetary policy. Central banks control liquidity through interest rates and financial regulation. When interest rates rise, borrowing becomes more expensive and risk assets often experience pressure. When rates fall, liquidity increases and capital tends to flow into equities, cryptocurrencies, and emerging markets. Inflation has also become a critical factor for investors. Rising inflation can reduce purchasing power and force central banks to tighten monetary policy. These changes influence everything from currency markets to commodity prices. For investors, monitoring inflation trends helps explain shifts in market sentiment and long-term investment strategies. Another major driver is the global commodities market. Energy prices, particularly oil and natural gas, have a strong influence on economic activity and investor confidence. When energy costs rise sharply, businesses and consumers often face higher expenses, which can slow economic growth. Conversely, stable or declining energy prices can support economic expansion and improve market sentiment. Geopolitical developments also play an important role in shaping financial markets. Trade policies, regional conflicts, and international cooperation can quickly alter global investment conditions. Even rumors or expectations about political decisions can create volatility across currencies, stocks, and digital assets. Technological transformation is another emerging driver. Rapid development of artificial intelligence, automation, and digital infrastructure has created new sectors while reshaping traditional industries. Investment capital is increasingly directed toward companies and technologies that support these innovations. As a result, technology-related assets have become a central focus of many portfolios. Investor psychology continues to influence market behavior. Fear and optimism can amplify price movements, especially during periods of uncertainty. When markets experience rapid growth, enthusiasm can push prices higher than fundamentals might justify. Conversely, periods of fear can trigger sharp corrections, even when economic conditions remain relatively stable. The challenge for investors is separating temporary noise from meaningful trends. Global markets generate enormous amounts of information, but not all signals carry equal importance. Successful investors focus on identifying the structural forces shaping long-term market direction, rather than reacting to every short-term fluctuation. Understanding the interaction between economic policy, commodity cycles, technological innovation, and investor sentiment helps create a clearer picture of the global financial landscape. While markets remain unpredictable in the short term, recognizing key drivers behind major trends can significantly improve strategic decision-making. Investors who monitor global macroeconomic developments and maintain a disciplined approach are better positioned to navigate volatility and identify opportunities.